Hello and welcome to IFRS Talks, your source for all things IFRS. I'm your host, Anu Pandya. On today's podcast, I'm very excited to be launching a brand new podcast series on IFRS Talks, focusing on IFRS 18. IFRS 18 is a new accounting standard set to redefine the accounting landscape. It's truly an exciting time for financial reporting. And with this podcast series, I'm really looking forward to decoding the changes that IFRS 18 brings. Across the series, we'll be unpacking various IFRS 18 topics, and I'll be speaking with different guests with a keen focus on IFRS 18, on what we can expect as we approach the implementation date. In today's episode, we'll be starting off the series with an introduction to IFRS 18. So if you're new to IFRS 18, you're starting at the right place. And I'm thrilled to be joined today by Katja van der Koe and Tanya van Eyck. Katja and Tanya are both part of the Corporate Reporting Services team in PwC Netherlands, and they lead our IFRS 18 accounting working group. Katja and Tanya, thank you for joining me on today's podcast.
Thanks, Anu. I'm very happy to be here.
It's great to be here, Anu. We're excited to be kicking off this podcast series with you.
Now, Katja, I know that we've been speaking a lot about IFRS 18, but there might be some listeners that haven't yet spent much time with the standard. Could you please start us off by explaining why IFRS 18 is making waves in the accounting world?
Of course, Anu. IFRS 18 is a new standard on presentation and disclosures in financial statements, and it represents a major shift in the accounting world. It replaces the existing presentation and disclosure standard IS1, and it's a game changer because IFRS 18 doesn't impact only one topic or only one particular industry. It affects a complete set of financial statements for all entities reporting on IFRS. I would say there hasn't been such a pervasive change in the IFRS accounting space for some time now. So it's making waves, as you said.
Yeah, I heard that Andreas Barco, the chairman of the ISP, said that IFRS 18 represents the most significant development in financial performance of companies since the introduction of IFRS accounting standard more than 20 years ago. So Katja, that brings me to my next question. Why did the ISP decide to come out with this new accounting standard? What drove the need for this change?
So the ISB developed IFRS 18 in response to strong demand from stakeholders and particularly from users of financial statements for improvements to financial performance reporting. And there were three main areas of feedback that the ISB received. Firstly, statements of profit or loss vary in structure and content, which made it very tricky for investors to compare entities even if they are in the same industry. Secondly, users also look at measures defined by management that communicate information about performance, but companies don't always explain how these measures are calculated or why they are used. And then thirdly, there was also feedback that the balance between information presented in the primary financial statements versus what's in the notes is not quite right. So overall, the standard seeks to improve communication of financial performance.
So it sounds like IFRS 18 is really the standard for users. But before we get into the details of how the standard achieves these objectives you've just mentioned, Tanya, can you please let our listeners know when the standard is mandatorily effective?
So there is a bit of runway. The standard is mandatory effective from 1 January 2027, but it is required to be applied retrospectively. So, for a company that applies IFRS 18 on the effective date, the annual financial statements that are issued on 31 December 2027 will present comparative information as of 31 December 2026, applying the requirements in IFRS 18. So the comparative period really starts in January 2026. Companies are required to apply the new requirements in interim financial statements in the initial year of application. So, for example, if a company is preparing an interim report for the period ending 30 June 2027, comparatives should be presented for 30 June 2026.
Thanks, Tanya. It really feels like time is ticking away since the standard was issued in April of last year. In fact, it's actually been almost a year and a half, so time is really flying by. Coming back to you, Katja, you mentioned that there's three objectives of IFRS 18. Could you please unpack the first one, which was about improving comparability for the income statement? How does IFRS 18 aim to achieve greater comparability?
Sure, it does this by defining the structure of the income statement. Income and expenses will now need to be split between 5 categories, and those are operating, investing, financing, income tax, and discontinued operations, and this will be based on specified criteria. The categories are somewhat familiar because today the cash flow statement has operating, investing and financing classifications as well. However, interestingly, description of the categories in IFRS 18 is not aligned with those in the cash flow statement. Defined subtotals will also be required to be presented in the income statement, and IFRS 18 introduces two new defined subtotals, which are operating profit and profit before financing and income taxes. Because of these requirements, it should be a lot more effective for users to compare entities' financial performance because of the standardization that the new requirements bring.
Yeah, I know that there's been a lot of questions and discussion about category-related questions. I'm sure we'll be discussing that in some future episodes, but at a high level, Tanya, could you explain to our listeners what goes in the operating, investing, and financing categories of the income statement?
Sure, so let's start with investing. The investing category includes income and expenses from assets that generate returns separately from a company's business activities. For example, a company might collect rentals from an investment property or dividends from shares in other companies. It also includes income and expenses from cash and cash equivalents and investments in associates and joint ventures. The finance category includes income and expenses on liabilities such as bank loans and bonds. Essentially, those liabilities arising from pure financing transactions, and also interest expenses on any other liabilities, for example, on lease liabilities or pension liabilities. So the finance category will include interest expenses on all liabilities. Thirdly, the operating category includes income and expenses that are not classified in investing, financing, income taxes, or discontinued operations. The operating category is the residual category and includes all income and expenses arising from a company's operations, and includes, but is not limited to, income and expenses from a company's main business activities.
It's interesting that you mentioned that the operating category is a residual category. I know that at some point the ISP was considering defining operating profit, but in the end they decided not to do so. Instead, the operating category is a residual category, as you mentioned. Now, Tanya, what you've just unpacked there was the general model, so to speak, but there's also some requirements for entities that have specific main business activities. Do you mind please explaining to our listeners how those requirements work in conjunction with what you've just explained?
Sure. So some companies invest in assets or provide financing to customers as their main business activity. You can think, for example, at banks or insurers. Income and expenses that would otherwise be classified in investing or financing categories would form part of the operating results for such companies. IFRS 18 requires these income and expenses to be classified in the operating category so that the company's main business activities are reflected in the operating profit subtotal.
Right, so that way, IFRS 18 ensures that regardless of what your main business activity is, the operating profit subtotal reflects the company's main business activities. That makes sense. Thanks for that, Tanya. Right, so if we move away then from categories and subtotals, Katja, if I could come back to you on the second objective of IFRS 18 that you referred to earlier. You mentioned information on measures defined by management that communicates information about performance. Now, I know that IFRS 18 introduces new requirements relating to management-defined performance measures, or MPMs for short. For those that are brand new to IFRS 18, please could you explain what are MPMs?
MPMs are alternative or non-GAAP performance measures, so measures that are not defined by IFRS accounting standards, and they are related to the income statement. Specifically, MPMs are subtotals of income and expenses other than those listed by IFRS 18 or specifically required by IFRS accounting standards. A company uses in their public communications outside of their financial statements to communicate to investors management views of an aspect of the financial performance of the company as a whole. IFRS 18 requires companies to disclose information about MPMs, which will increase transparency and investors' understanding of how the measures compare with the measures defined by IFRS accounting standards.
Thanks, Katja. I think that's helpful to highlight that MPMs are just income and expense subtotals, so not every single alternative performance measure that a company might disclose outside of their financial statements. There's a lot to say about MPMs, and I'm sure we'll cover that in future episodes. But for now, let's move away from MPMs. Tanya, the third objective of IFRS 18 that Katja referred to earlier was about the balance between information presented in the primary financial statements versus what's in the notes. So how is IFRS 18 improving this balance?
Well, the standard has created a clear distinction between the roles of the primary financial statements and the roles of the notes. The role of the primary financial statements is to provide a useful structured summary, whereas the role of the notes is to provide material information to supplement the primary financial statements. These are definitely complementary roles, but the distinction should help to get the balance right between what's in the primary financial statements versus what's in the notes. To further help with the balance, there is also enhanced guidance on grouping of information. The aggregation and disaggregation criteria helps companies to give the right level of detail that provides a useful structured summary.
Thanks, Tanya. I think useful structured summary sounds like a straightforward concept, but I'm sure there's actually a lot to unpack there, and maybe we'll again save that for a future episode in the series. So far, everything we've discussed has either been a presentation or a disclosure matter. I think it's worth mentioning to our listeners that IFRS 18 doesn't introduce any new or change any existing recognition or measurement requirements. Are there any other aspects of IFRS 18 that you think are worth highlighting that we haven't already mentioned?
Well, we've already mentioned it replaces IS1. Many requirements of IS1 remained unchanged by IFRS 18. For example, the requirements relating to going concern and the current, non-current classification of assets and liabilities. So these requirements have been carried forward with limited wording changes to IFRS 18. There were also consequential amendments made to other IFRS accounting standards as a result of IFRS 18. The most significant of these consequential amendments is the amendments made to IS7, the standard on statement of cash flows. The current guidance in IS7, that is before the IFRS 18 amendments, requires the use of profit or loss as the starting point without defining what profit or loss refers to. IS7 will now require all entities to use the same starting point for the indirect method to reduce existing diversity in practice. There also used to be room for policy choices on interest and dividend cash flows, but for most corporates this choice has been taken away, and there is now clear guidance around classification for interest and dividend payments and receipts.
Thanks, Tanya. What about the balance sheet? Are there any changes to the balance sheet?
Well, not much has changed there, apart from the fact that goodwill is now a required line item for presentation on the balance sheet. Of course, the new requirements on grouping of information apply to the balance sheet and cash flow statement as well. So those new requirements should be considered for those primary financial statements.
Thanks, Tanya. I think that then covers us for all of the biggest changes that have been introduced by IFRS 18. Katja, as our IFRS 18 working group chair, I know the standard has kept you quite busy and there's been a lot of lively debate on the requirements. Are you able to please share some more details of what types of questions we've been discussing about IFRS 18?
Sure, and I agree, it has kept us quite busy and it has been interesting discussions. And I'm sure we're not yet done debating, but I can give some more details. So there's been lots of discussions around MPMs. For example, what does used in public communications really mean? Or what does management's view of an aspect of financial performance mean? Which subtotals are in scope of the new disclosure requirements and which are out of scope? So many questions on MPMs. Then we also received detailed questions on the new requirements relating to grouping of information. The core of these questions is really about the interaction between the concept of a useful structured summary that Tanya talked about, the requirement for aggregation and disaggregation, and the required line items within IFRS 18. There are also questions around what's the interaction between the offsetting requirements in other IFRS accounting standards and the aggregation and disaggregation requirements in IFRS 18. Furthermore, and surprisingly, a lot of treasury topics have kept us busy. There are, for example, requirements about classifying foreign exchange gains and losses and gains and losses on derivatives in the operating, investing and financing categories. And those have already sparked some very deep discussions. In fact, we noted that there's a matter for the IFRS Interpretations Committees about the classification of foreign exchange differences on intercompany borrowings. So that's definitely one to keep a look out on. There are also requirements in IFRS 18 on the classification of income and expenses relating to cash and cash equivalents. Normally, this would go into the investing category if you're a corporate, like Tanja mentioned earlier. But what if you have a bank account that fluctuates between a positive and an overdraft position? Tanja also earlier referred to a distinction between liabilities that arise from pure financing transactions and other liabilities. Well, there's been some discussion on how to differentiate between what's pure financing and what's not. I won't go into too many details on this. I'm sure, Anu, that this is an area that you want to unpack in more details on future episodes. Lastly, as Tanja mentioned earlier, there are specific requirements for entities that provide financing or invest as a main business activity. So there's been many questions from our colleagues serving clients in the banking, insurance, and asset management space about how these new requirements apply in these industries. So I guess that's some flavor of what we've been discussing, but I'm sure there's much more to come.
I'm sure there is, Katja, and that was actually the perfect teaser of what our listeners can expect from our future discussions over the course of this podcast series. Those are exactly the areas that I wanted to decode. Tanja, perhaps one last question for you then. What are some of the operational challenges that you've been hearing about so far from implementation efforts, and what types of implementation considerations do you think companies should keep in mind?
So far, it seems many companies are at the beginning stages of their implementation journey. So I'm sure we'll hear more as we approach 2026 and then also 2027. But like you said earlier, time is really ticking away quickly. Implementation of IFRS 18 might require entities to assess their internal processes and controls. Are reporting system changes needed? Are data collection procedures changes needed? How will the financial statements reporting process need to be updated, including interactions with management reporting? And how will the implementation be communicated to the users of the financial statements? These are all some questions to consider. There's potentially more collaboration required between a company's financial reporting team and other teams, such as investor relation teams. Of course, entities subject to internal and external audit would also need to keep audit considerations in mind.
Yeah, thanks, Tanja. And like we said at the start, IFRS 18 is a major accounting development, so it is fitting that the implementation efforts would be considerable. So I think that brings us to the end of this episode, our introduction episode. Thank you so much, Katja and Tanja, for joining me today on the podcast. You've really kicked off our podcast series in the best way. You've set the scene and you've given our listeners an idea of what they can expect for the rest of the episodes in the series. So thank you very much for that. And thank you to our listeners for tuning in. Please stay tuned for further episodes in our Decoding IFRS 18 series. Links to our published IFRS 18 guidance are in the episode description. To never miss an episode, subscribe wherever you get your podcasts. And until next time, happy accounting and reporting.
This podcast has been brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitution for consultation with professional advisors.